Hi, welcome to the Asia Climate Capital podcast. In each show, we tackle the business and finance trends of the energy transition and decarbonization in Asia, with the capital markets in mind. Please do send us comments or topic ideas to the Asia Climate Capital podcast at gmail.com. This will allow us to make sure the content is useful and relevant to you as well as other listeners. Welcome to the third episode of the Asia Climate Capital podcast. It's the 22nd of March 2022, and the guest today is Stephen Liu. Steve is another great veteran of the finance and financing of the energy sector in Asia Pacific. He's really a leading voice in the sector with his 4 decades of experience. In terms of background, Steve went to Canada for his university studies and started his career there. For a decade, he worked as a bank economist, a consultant, and a corporate banker there in Canada. He moved back to Asia in the early 1990s. He spent almost 2 decades in project and corporate finance at some of the region's leading financial institutions, names such as HSBC and Macquarie. He then went to contribute his expertise to corporates, chiefly renewable energy sector leaders in the region. Currently, he is a consultant with the Asian Infrastructure Investment Bank, or AIIB. AIIB is a multilateral development bank set up in 2017, focused on developing Asia, but with over 100 members from all over the world outside the OECD countries. Please do note, Steve's statements today are purely his own and do not represent the opinions of past or current employers. Hi, Steve. Thank you so much for agreeing to spend the time to speak to us on the Asia Climate Capital podcast.
Morning. You're most welcome, Joseph. And thank you for inviting me to your podcast. Look forward to our conversation.
Great. Same here. Definitely have lots of questions for you. So if it's okay with you, firstly, obviously I've introduced you. We also have your bio on the show notes, but I wanted to understand how you actually became part of the Asian energy transition, let's call it movement. And then we're going to dive into one particular issue which you think is key to the sector, and then we'll move on to getting some forward-looking thoughts from you. How's that?
Oh, sounds like a good plan.
Cool. So I'll go with my first question. So you as mentioned a couple of times already, you've been in this energy business and finance business for almost 4 decades. So my first question is, when and how did you decide to become involved in the Asia's energy transition?
Well, Joseph, I was very lucky to be involved in the first ever wind energy acquisition financing in Taiwan back in 2008 when I was working for ANZ. We were supporting.
Wow, that was really early days.
Well, given the fact that this business really took flight in the last 15 to 20 years, people seem to have forgotten that feed-in tariff didn't appear until Germany introduced it, I think, in the early 2000s. So that started off the whole game of renewable energy investments and whatnot. And of course, when you have to invest, you also have to finance. And so Macquarie was looking to acquire its first ever onshore wind farm in Taiwan. And at that point in time, ANZ was able to come up with an acquisition financing. And I worked on it. And to be honest, got smitten a bit about this whole renewable energy business. Then on my next deal, I worked on an IFCB loan on a China onshore wind deal, followed by another wind deal working with European development financial institutions and regional banks in India. After these 3 wind deals for both ANZ and another bank that I was working at, I really see the trend of renewable energy growth worldwide, especially in Asia, especially in developing world, Asia, because as you know, the developing world in Asia still at this point is quite reliant on coal-fired fuel plants. And that is doing a lot of damage to the environment via the carbon emissions. And at that point in time, especially when you're doing project financing like myself, you use a lot of research material. And I was lucky enough to be a subscriber to Bloomberg New Energy Finance. I want to give them a plug. Set in a couple of events led by Michael Liebrich, and the numbers really made sense. The company had a very good analyst, Jenny Chase, who really told a very compelling story of who is doing what in the renewable energy space and how much momentum there is renewable energy. So by about 2012, I think at that point in time, I felt that after 30 years of being a banker and a consultant, a management consultant, that's enough for me on the sell side. So I thought with all this momentum growing in the renewable energy space, a lot of new players coming into the market, these players probably need financing, and they can probably use someone with project finance experience. So I thought I'd give it a try, and was lucky enough to found a niche in the solar energy market. So I stepped over to renewable energy in 2012.
Oh, that was very, very early on. I think I got interested in this back in 2003, 2004 when I was at Merrill's, and I wrote my first, and China issued that first renewable energy kind of plans. But there was very, very little interest at the time. Nobody thought it was real. And because obviously it was too expensive. But very quickly, before we get into the kind of nuts and bolts of the discussion today, do you have any thoughts or suggestions for individuals who are interested in getting involved in the energy transition in Asia, be it fresh grads or seasoned professionals?
Well, Joseph, thanks for asking that question. For someone like myself who's been a professional both on the, shall we say, sell and buy side of the operations, I have pretty well seen the whole project development and financing process, including, I would say, the entire ecosystem, where you're relying on legal talent or technical advisors or insurance advisors to get a project up and running. So I would say the current transition is really buttressed by overarching policy goals and also ESG concerns, environmental, social, and governance concerns at a lot of corporates. That's part of their mission statement going forward to meet the 2050 Paris Agreement goals. So the whole sustainability clean energy ecosystem is alive and well, and actually is creating a lot of new job momentum. I think currently this energy transition will benefit anyone with a finance, engineering, business, legal, insurance, poli-sci, political science, and consulting background. I am particularly encouraged by many universities around the world nowadays introducing ESG or climate-related courses. So they are really incubating the new generation of young talents. Roll the clock back 15 years ago, I challenge you to find one or two schools in the world that are actually offering this discipline as a targeted topic. Then for the more experienced professionals, I have seen engineers becoming project developers or dedicating themselves to R&D, manufacturing of plant and equipment across the AIIB value chain. I mean, to be honest, Joseph, someone has to come up with that design for a floating offshore wind farm platform or a 16 megawatt offshore wind turbine. or some of the engineers have become third-party independent consultants. I have also worked with CPAs and MBAs becoming corporate finance professionals or asset managers. Brokerage sector analysts have switched over to ESG scoring. Credit analysts fully engaged in credit ratings for the sector, or insurance brokers specializing in renewable energy. Then, not to mention, as new products emerge from carbon trading to green loans and bonds, the legal beagles, our friends in the legal profession, also have a field day. What is more encouraging is that the current wave of transitioning is spilling into family offices and specialized investment vehicles. And on this one, I would say watch the SPACs, the specialized investment vehicles that are now being considered to be listed in both US and Asia. Since you and I sit in Hong Kong, I understand there possibly could be half a dozen coming up within the next 2 quarters. On top of it all this momentum are not only creating job opportunities, but also creating job opportunities across genders, which is very important these days, and good to see a lot of female professionals coming in to join this renewable energy business.
Actually, I totally agree. I've got a list of podcast victims, let's call them, guests, and I was and it was actually quite easy to find males, and then finding females was actually quite a bit of a challenge. So we definitely need more females in this business, and there's no reason why not. So
you have to give Jenny a call.
Exactly. Now, these are great insights, and thank you for that. Moving on to kind of your thoughts on the sector. Out of all of this immense number of issues related to climate finance in the region, if you were to just pick one, because we only really have time to speak to about one, what would it be?
Well, it's a good time for you to ask me that question, Joseph. I recently contributed to an article looking at the rise of corporate PPAs, corporate power purchase agreements, in mainly the Southeast Asian region. And this is one of the areas of tremendous potential for growth. As COP26 just ended late last year, it really provides even more incentives for ASEAN countries to liberalize their individual power markets. Governments alone cannot do everything in this energy transition. And countries must have the full participation of the private sector players as well in order to make this a fruitful and a successful campaign. So the key drivers I see in the whole development and emergence of corporate PPAs, I see 3 factors. Number one, regulation promoting fairness and competition are being promulgated in various countries that I looked at together with my co-authors in Southeast Asia. There is now a more clarity of roadmaps in order to transition to renewable energy, thanks to various countries coming up with their own plans to meet the Paris Agreement goals of decarbonization, and also to try to lower the world's average temperature by 1.5 degrees by 2050. And thirdly, I also see the need to maintain overall power affordability, particularly in the developing world. So CPPAs, corporate PPAs, are probably the most convenient way for private sector to get involved.
Right. I think it's a really key issue, because at the end of the day, we are talking about, the project needs to be economically viable. So obviously you need to be paid something for the power you produce, because it costs quite a lot of money to build the facility. And so, the PPA is actually quite important. And now we're seeing this, trend of corporate PPAs. So it's a great subject to be discussing. So let's start with a very broad 30,000 feet question, if you don't mind, Steve. Could you define what we mean by PPAs, and especially in Asia Pacific? And also, could you put it into the context of the investors? And what I mean by investors is both the direct investors, be it private equity investors or corporates, and then as well as capital markets investors, being, the equities, fund managers, investors, credit investors. All of that in 30 seconds. Just kidding.
It makes sense, and you should do it. PPAs are essentially, quite simply, a conduit that allow the sustainability-focused corporates or investors to accelerate the individual reduction of carbon emissions in its corporate activity footprint. On top of conservation, these corporates are actually directly procuring clean energy for their own production or supply chain, i.e. to purchase clean energy from its supply chain in order to meet their individual ESG goals. So these corporates can either underwrite a PPA with a power generator or buy renewable energy certificates. A corporate PPA is a long-term contract where the corporate buys electricity from a private rather than utility electricity producer. A corporate PPA allows for cash flow and volume certainty and ultimately helps drive project bankability and raise finance against it. It is also in reaction to the withdrawal of feed-in tariffs, except the best example we have seen in the last couple of years in Japan and China, where feed-in tariffs are no longer offered. You go into bidding situations. Especially countries are incentivized by the fact that overall CAPEX for both wind and solar, less so for, I would say, waste to energy and biofuels, are coming down quite tremendously. So you don't really need that so-called subsidized element in a tariff anymore. I always remember my ESG training where, the pursuit of ESG goals such as clean energy not only serves corporate governance KPIs, but at the end of the day, ultimately, it is also profitable to investors, as clean energy has long asset lives, but with zero operating fuel costs. If you're driving a non-electric vehicle these days, just look at the gas pump in the last 2 months, and you know exactly what I mean. Also, one can bundle a portfolio of these projects and maybe serve as cornerstone assets for a SPAC or a climate-related private equity fund. Broadly speaking, Joseph, we have 3 types of CPPAs: private wire, physical, and synthetic. In terms of private wire PPAs, these are direct sales from a generator to an off-taker. The best example is a rooftop solar project. It is good for countries with grid concerns in particular. In terms of physical PPAs, even though there is a direct PPA, the generator still needs the local grid to deliver the amount of electricity it contracts for a fee. Synthetic PPAs, these are generally referred to renewable energy certificates, which is essentially a financial derivative. So the buyer would purchase the rights to the RECs, renewable energy certificates, generated by a renewable energy producer, and then trade the instrument on exchanges or keep it until it reaches a certain value that they see they can take profit on. So they also serve as a price hedge if signed over a longer term, say 10 years. So you can see the entire spectrum of either direct, private wire, or synthetic PPAs all go towards contributing to the decarbonization goals of many countries and many corporates.
I guess you indirectly answered my next question, which was, is having a PPA absolutely crucial to the bankability of a project? Which I guess the answer is yes.
Well, it would definitely help. But as we know, there are countries that PPAs are not
very common.
I was going to go into market opening and then Singapore and Australia, but then we're talking about corporate PPAs. So
yeah, but I mean, I guess China is one example where you've got a humongous market, but right now you don't really have a lot of corporate PPAs. Although corporate PPAs in China do exist between
Yes.
power generators and some, for example, industrial parks or some warehouses or whatever. So
definitely.
So so I guess the next question is, broadly speaking, what is the motivation for corporates? And I guess here we're talking about corporates which are not in the energy business, so non-utilities, non-oil and gas companies, to enter into PPAs. Why would I want to do that? And just to be specific, we're talking about, again, companies not involved in the energy business. So what's the motivation?
Well, Joseph, as I look around what's been happening in the corporate PPA and renewable energy development side of things, with Paris Agreement and COP26, the corporate world is now extremely mindful of its responsibilities as a corporate citizen. For this, I would say, let's look at the initiatives of the 300 plus companies that have formed the so-called Renewable Energy 100 companies. It's now 3 times that. That's RE 100 companies. They cover every sector from manufacturing to pharmaceuticals, technology, and these companies represent over 175 markets, and they have pledged to procure as much clean energy as possible through their individual manufacturing or servicing processes. So be it public or private enterprises, the world is watching how you are committing to carbon reduction and help the cause to reach the goals as agreed to under Paris Agreement. As we drive towards 2050, the decarbonization goals. So for public companies, there are now ESG scores on top of the annual financial returns matrices that they pay attention to, and where investors also pay attention to. The higher one's ESG score may actually bring financial benefits, as more investors with a similar interest will target your company for its investments. So ESG investments is actually value accretive rather than value destructive. And that's a very important point to remember. So to a corporate these days, a PE ratio, I would say, is as important as the number of tons of carbon it removes in a year.
All very good points. Although right now there's still some non-believers that are arguing that ESG is not doing its job, and my 2 pennies worth here is that it is something that is fairly new. It's evolutionary. So saying that it's not perfect is true. But the motivation, the momentum, or like I like to say, the train has already left the station anyway. So whether you like it or not, that's the new normal, right? So you got to do something about it.
Yeah. And Joseph, at the end of the day, there is no planet B. So if we don't get our minds and hands and feet together and drive towards that decarbonization goal, as we reach a potential disaster scenario for this little blue planet, what are we telling our next generation and generation after that? We really didn't bother to clean up. So here's the mess, and you're not going to have a planet.
Right. Absolutely. There is no planet B or plan B. Planet B or plan B. On the corporate renewable energy procurement front, what has it been like in the region? I mean, I know it's something fairly recent and fairly new, but based on your kind of experience of what you've seen, what is kind of like what's the trend been like in the region so far?
Sure. in doing our research for the article on corporate PPAs, we actually found a very recent report from industry consultant Wood Mackenzie, a company that you know well. They reported that in 2020, CPPAs in Asia reached 3.8 gigawatts, which is a doubling from 2019 figures. And by mid-2021, corporate PPAs in Asia actually reached a total of 10.9 gigawatts of volume of power that are being purchased by corporates directly. So most corporates are attracted to the falling renewable energy premia, yet still decent tariffs compared to elsewhere in the world. And I'm talking about Asia compared to, say, parts of Europe or USA. So, there's still, put it crudely, money to be made. In Asia, I would say India, Australia, and Taiwan are ahead in this CPPA regime. Singapore and Japan are closing in fast. Singapore is a standout in Southeast Asia, I would say, but the lack of land is its biggest impediment. As to the buyers, industrials counted for 60%, roughly 60% of CPPAs underwritten in 2020, particularly high energy consuming sectors like mining and manufacturing, then followed by retail and service off-takers, and the IT advanced manufacturing sector rounded out the picture. Consultant Wood Mac also observed that about 10% of the 99 AIIB 100 members have signed CPPAs in Asia, mainly due to limited regulations permitting off-site large-scale procurement. So clearly, there, with over 300 members in the AIIB 100 group, and you only have 99 that have signed up in Asia, I would definitely call CPPAs, this wave of CPPAs in Asia, a work in progress. And but I'd say the overall momentum is very positive.
Got it. There's something that I'm wondering about, because when I think about a corporate power purchasing agreement, I think about mostly, selling. I build a project and I sell the power to one single user. Now, I know there's different dimensions and different ways that this happens, but when I think about a decade ago, I was involved in a project where you built the facility, and then by the time you finished it, you completed the facility. Actually, your off-taker, the person supposed to buy the power from you, went bankrupt. So again, there's many dimensions that one can look at in terms of corporate power purchasing agreements. But what about the risk side of things, specifically counterparty risks? In other words, like I was saying, if I build a solar power plant and I enter a long-term agreement to sell the electricity produced to, for example, a factory, what happens if the factory goes bankrupt? In other words, how do we get our heads around the counterparty risk?
Well, Joseph, I kind of expected that question since, I come from a project finance background, and risk analysis and mitigation is the mainstay of my profession. So as a banker, what I've learned in terms of analyzing a credit, the best way and the only way to start is a thorough credit analysis of the buyer. That sounds like mom and apple pie, but I would say that one should really take a deep dive on the sector that you're looking at, analyze the level of competition in that sector, the particular target's operations, and then that target's own financials. So what you're basically trying to gauge is what market share that target has and how vulnerable that target is to competition, and also how easy it is for competition to get into the market in order to create more competition for your target. So on that one, I would even suggest you talk to that target's bankers or suppliers, if need be, to find out how strong a credit they are, how good an operations they are, how well managed an operation they are. Draw your own SWOT analysis. identify the strengths, the weaknesses, the opportunities, and the threats that may impinge on your target. Then, before making up your mind, also many companies operating here may be subsidiaries, here meaning Asia, may be subsidiaries of multinationals. So ask yourself or ask your target, can you discuss a potential parent credit support to the local operation in order to support its own credit, especially if it's a newer factory that doesn't have a long track record trying to break into the market, or it's a highly competitive industry. Then really it's up to some clever and often, what I say, gloves off negotiations for items such as termination payments. I am aware some Hong Kong developers of rooftop solar have successfully negotiated for early termination payments from larger corporates that would actually include their base case IRR, the agreed IRR in the termination payments. So let's say, for example, in the Hong Kong scenario, the feed-in tariff is 15 years from 2018 that runs out in 2033. So we're already, 4 years into the game. Let's say if you struck up a corporate PPA now with a logistics center, you only have 11 years left. Let's say in the 6th year, there's something bad that happened to your factory or your logistics center, and it keels under. Can you negotiate a early termination payment so that they actually pay you out for the remaining 5 years of the term of the PPA, including your equity IRR, so that you're protected in terms of your investment? Also, it goes back to my earlier point of how lawyers are needed a lot these days in our space. They can get you out of trouble early if a CPPA is crafted correctly.
Gotcha. Just a follow-up question on that. Is there, obviously you're going to have some markets that are a little bit more sophisticated in terms of like the buyer and the seller markets, such as, Hong Kong and Singapore, et cetera. What happens to kind of newer markets where this is brand new? And I'm thinking of places like, I don't know, ranging from Cambodia to Sri Lanka. Do they get some kind of help from somebody? Is there like some, do they get help from multilateral banks or from, some international banks in terms of how to set the whole thing up?
I think you really have to look at country risk, sovereign credit rating as a start. I would say some of the, shall we say, less fortunate and lower tiered rated countries, you will probably rely upon a multilateral or a development financial institution in order to guide the financing, because the local banks usually do not have a wealth of experience in looking at this emerging sector called renewable energy and look at all the risks sensibly in order to come up with something close to what we call limited recourse type of financing. Conservative banks will usually just go, sure, give me a corporate guarantee and away you go. But not every developer or owner is able to do that, or their credit is strong enough to do that. So especially for some of the lower tiered countries, I would say, yes, you should get your multilaterals involved. But there is a price to pay. Some of these organizations, they really are not geared to take on the smaller portfolios. So I would say if you have a portfolio of projects that you can bang together, even if it involves 3 or 4 different CPPAs with different, hopefully creditworthy entities, bang it together into a portfolio so that it aggregates up to, I would imagine, around 25 to 30 megawatts in total as a portfolio before you take it to the banking market. That's the reality of the game, because as a banker, I always look at the fact that you do the due diligence a thorough due diligence on a 1 megawatt project, it's about the same time and resource that you have to spend on it as a 30 megawatt or 100 megawatt project.
That's something which I think deserves its own podcast, which is the financing of small renewable energy projects. Where does a 5 to 10 megawatt project get its money? But I guess it's a very long conversation. So we'll keep that to maybe the next time that you can be our guest.
Well, the good, okay, just a couple of hints there. The good thing is now there are a lot of private equity funds that are targeting this sector, and sometimes it's not easy for a new fund to just go out and acquire readily built projects of 200, 250 megawatts to start. So sometimes they're willing to take, and I know of a couple of funds especially based in Singapore, funded by European DFIs that are specifically looking at, shall we say, the more challenging piece of the puzzle, i.e. the construction risk piece. So they're willing to take an equity-like return by offering mezzanine financing to gap the project through the construction phase.
We're definitely going to get you back and talk about financing small clean energy projects. It's a topic close to my heart. But moving on, there is something like 50 different jurisdictions in the Asia Pacific region. If we look at the United Nations definition, so obviously there's going to be some massive differences as these power markets differ in terms of size, the different terms of economic development, and especially different terms of energy sector regulatory structures. Still, could you perhaps speak on 2 or 3? Because obviously, we don't want to go through 50. Could you just speak to 2 or 3 representative markets, and then perhaps deep dive into how renewable energy PPAs have evolved in those markets?
Okay, Joseph, I'll pick 2. I would say a more advanced market and then one emerging market. So I'll pick Singapore and Vietnam. For Singapore, it's primarily rooftop solar market for CNI. CNI stands for Commercial and Industrial Marketplace, and Singapore's government housing market. Singapore does have the housing board and the urban housing board, and they happen to have a lot of buildings. And so they're slowly putting rooftop solar on each and every one of those the hub housing buildings, which is very good to see. Typically, these are private wire PPAs that may or may not be grid connected. Also, we're seeing a bit more synthetic PPAs for buyers that do not have property to locate the systems. Well, for Singapore, thanks to its flat topography, small size, and government foresight, I would say, the buyers can have the flexibility to tap in and out of the grid connecting points so as to accelerate discussions between demand and smaller rooftop generators. Also, as the government recognizes its geographical limitations, a couple of regional cross-boundary projects are now being planned. One that is very exciting these days is a Western Australia-based solar project that we're talking about, hundreds of gigawatts if come to fruition, and they'll be exporting solar power via undersea cable to Singapore. And another one is the Laos to Singapore via Thailand, Malaysia interconnections to import solar energy from Laos to Singapore. So these are initiatives that we must congratulate the Energy Market Authority of Singapore being on the front foot of all these initiatives in order to meet Singapore's planned 7x increase, 7x increase for solar power by 2030. Exciting stuff happening in Singapore. So let's take a look at an emerging market situation. Let's pick Vietnam. Well, Vietnam has been phenomenally successful through its international tendering exercise of utility-scale projects, utility-scale solar projects. backed by the earlier US 8 cents per kilowatt hour FIT. So now the country actually boasts Southeast Asia's highest installed capacity for solar. By 2020, the rough count is 16 or just below 70 gigawatts. The solar industry is also closely watching the development of Vietnam's direct PPA market. Its Ministry of Industry and Trade has now come up with a pilot program. So some key features of this DPPA program in Vietnam. It includes a 1 gigawatt target for approved wind and solar projects above 30 megawatts. Both the generator and an industrial consumer will need to apply together, and they must commit to a COD, a commercial operating date, within 270 days from the date of selection announcement. The timing constraint, I think, clearly will favor those parties that have land already acquired and those industrial players that already have identified a renewable energy partner. I guess the $64,000 question remaining for Vietnam is who takes the poles and wires curtailment risk. That is a question that still remains largely unanswered as of now. Exciting developments in Vietnam, but not totally without risks, Joseph. So tread carefully.
These are two great examples. I mean, be interesting to go through some of the other key markets, but I think that gives a little bit of a flavor of the range of stuff that is happening in the region. The last question about the current situation in the Asia Pacific renewable energy power purchasing agreement sphere. Now, there's been trends where the levelized cost of electricity, the cost of the production of the energy, the levelized cost of electricity for renewable energy, and the tariffs in some of the key markets. And a related question is, with regards to the current circumstances, if I've just recently signed an agreement, say it lasts, 3-4 months, then what happens to my construction costs? What happens if my construction costs or my equipment costs suddenly and unexpectedly rise? Will that significantly lower my return on investment? The reason I'm asking that is because we've seen a lot of supply disruptions and also the price of key materials used to make renewable energy equipment, be it wind turbines or solar cells, to going through the roof recently. So and the Putin's war, which started almost a month ago, has worsened these supply chains, and also maybe driving inflation higher for longer, based on experts. So again, the question is, what happens if I've already signed my PPA or just recently, but my costs have gone up? So suddenly I'm facing lower costs but a fixed price of sales price.
That's an excellent question, Joseph. As I'm still quite involved and connected to the solar industry in particular, I would say the last 2 years, we have seen many very tough conversations to reopen price discussions between suppliers and the individual power producers, mainly due to the tremendous supply and logistics chain shock derived from COVID. I am personally aware of some suppliers having to ask for higher prices, but have been met with great resistance by the buyers. That reflects a very real problem in this industry, is that many projects, small and big, are bid out. So there is a certain lead time involved in locking in the EPC contract, and then the final, the subcontractors' prices, both on plant and equipment. Usually this may be a period of 6 months to even longer lead times before actual delivery starts, because ahead of this, shall we say, ahead of the first shovel being laid onto the ground to start the project, I'm talking about utility scale here, you have to finalize your negotiations on the PPA. You have to wait for government permitting and consents. You have to clear the land. mobilize the EPC, and obviously you have to close financing as well. So these all takes time, and things could have happened in the interim, like you said. All I can say is that the time that all I can say is now is the time that favors the long-term loyal customer, so that the supplier is willing to sit down and see if there's a possible middle ground with that long-term customer. For example, if I really need that extra 2 cents per watt on transport costs to get my shipment across to you in East Asia, can I do that with less? Can I take it out of my own margin, but preserve the significant hard-won customer relationship? Because after all, you're giving me 500 megawatts to a giga of orders annually. So I have to make that decision. I have to sit down with you and work it out. Can your project actually sustain a bit of a delay, say a few months delay, if you wait it out? Because hopefully I see forward prices in some of the silicon or wafer prices coming down, not immediately, but 3 to 4 months from now. So I can ship it to you instead of 3 months from now, I can ship it to you 6 months from now, a bit cheaper. So can your project sustain a bit of delay? This is a fine balance. And it has been, I must say, it has been brutal, and not every renegotiation ends up where both sides are happy, as you know. So let's say so at the end of the day, I would say this is a blip in the long run of the sector's long-term development. Happy to report that some essential raw material costs like polysilicon and wafers for solar panels and logistics costs have actually returned to some normalcy in the recent 2 quarters, especially for the intra-Asian trade.
Yeah, I think it's an important. I think it's a really important question. Not because I asked it, obviously, but because of what we're seeing now in terms of the amazing the disruptions and all of the criticism that is going on. There's been even some people arguing that this is going to hurt the growth of the energy transition or slow the decarbonization of Asia, which I absolutely do not believe will happen, because what is going on now is, like you said, just a blip, and something which the transition is something which is going to occur this decade, next decade, and so on and so forth. So it is just a short-term blip. Anyway, Steve, slightly changing gears, I want you to take out your forecasting hat and looking at over the next 10, 20, 30 years. In the region, what do you think are likely to be the most important developments in the corporate power purchasing agreement markets in the region? Are there 2 or 3 specific ones that you expect or you would like to see? Also, any specific possible developments in any specific market?
Well, the one big theme, Joseph, I see is clearly a matching of the COP26 goals with corporates' pursuit of carbon neutrality targets and carbon emission reduction. So with the continual declines in system costs, for example, I just saw an international consultant saying LCOE for PV, photovoltaics, solar energy, may go down another 45% by the end of the decade. This is a large incentive for any investor interested to lock in a fixed payment return in a typical solar project when your cost to build one project is declining. More importantly, as a financier, the rise of green financing and sustainability financing in both the loan and debt capital markets are clearly big positives. Found it really tough to raise third-party financing, but witnessed some pretty innovative products from Singapore banks in the last couple of years. A number of aggressive solar developers in rooftop solar space in Thailand, Malaysia, Singapore, and Indonesia now have successfully raised financing for growth. And that's, as I said, is an innovative product from a particular Singapore bank that I've been dealing with. I'm also seeing continued growth momentum everywhere. As my article on CPPA was based on Southeast Asia, let's not forget the momentum in North Asia that includes the unending growth in China, Japan, Taiwan, and South Korea. Particularly the last two countries, Taiwan and South Korea, they're really looking at offshore wind. And Japan is also now planning its first wave of offshore wind investments. There will be more excitement to come in Asia, without a doubt.
Great. A question actually not related to corporate power purchasing agreements, but obviously intimately, not directly related, but indirectly related, is I wanted to pick your brains on how you see what I would like to call the greening of the capital markets in Asia. And by greening, I mean financial institutions increasingly looking at green and sustainable projects and the various financial products and tools aiming to raise corporate responsibility, environmental goals, as well as to achieve decarbonization targets. So, how do you see how do you see the greening of the capital markets in Asia in general?
Well, I see this phenomenon continuing and actually picking up speed. Every international commercial or investment bank, MDB, Multilateral Development Bank, Development Financial Institution, DFI, and larger regional banks have their version of ESG goals and mission statements. Some banks have decided to put in a time frame to curtail or stop all coal-related or even oil and gas financing. Some former colleagues of mine dabbling in project and structured finance have now moved into sustainability or clean tech financing. There's also a wider product mix now across DCM, bank loan, and fund investments that promote green financing. Even in Hong Kong, we now have a Green Finance Association. And an Australian investment bank has acquired the Green Investment Bank from the UK in its entirety a couple of years back. So call it a perfect storm where global ambitions meet government policy, meet regulatory oversight, which then meet with financial players' single-mindedness to drive ESG KPIs. Just about the only risk I can see, Joseph, on the horizon is where will all the talent to support this growth to come from? Will there be enough human resources to fulfill the ambitions?
And that's exactly why I asked that very first question, which I think is absolutely essential. At the end of the day, I think the first driver of the energy transition, decarbonization in Asia and elsewhere is really education. And we're not talking about education just, in kindergarten, high school, universities, but also at government level and in financial institutions, et cetera, et cetera. So I think that is really, and that's one of the reasons behind this podcast. Hopefully people can get their head around what's going on.
This is a growth market, and I don't see an end to it.
Fantastic, Steve. Look, I really want to thank you for your time. You've been extremely generous. I really, really enjoyed the conversation, and I hope listeners will enjoy it as well. And once again, thank you so much, Steve, for your time.
Thank you again, Joseph, for inviting me to your podcast, and I look forward to the next time when we can talk a bit more.
Great. Thank you, Steve. I trust you found the conversation useful. As always, feedback is really key, and in order to make the content useful and relevant to you and other listeners, please do give us some feedback. Also, please like the podcast in whatever podcast app you use, and send us your comments, your thoughts, your ideas for topics anytime at the Asia Climate Capital Podcast at gmail.com. That's the Asia Climate Capital Podcast at gmail.com. Thank you.